Jeni Browne. Welcome to this week's MFB News. Hope you are all doing incredibly well. Now, for transparency, I am for a change recording this video on Tuesday because tomorrow morning I'm actually zipping off to Lisbon for a few days, lucky me I know. So I'm recording this video a day earlier than normal, which is slightly annoying because this morning Rachel Reeves announced that she was going to do a kind of unexpected speech and talk to people about kind of I guess the kind of context around her thoughts for the autumn statement. So the net effect of this is that these swap rates may react to that, and in which case I'm a little bit early. The way that swap rates are reported, we can only get access, which is almost from the previous days. So the swap rates that I can see currently are from Monday night, so they're going to be a bit out of date. So I think we're just going to need to catch up on how the capital markets reacted to Rachel Reeves' speech next week, I'm afraid. So I'm really sorry for that. It's just really unfortunate timing. If Rachel Reeves hadn't decided to put her speech in the very day before I disappear off on holiday, this wouldn't have happened, so I'm blaming her. So we'll come back to that next week. But in terms of what else we're going to be covering off for you, we are going to be doing our usual roundup on where swap rates were as of Monday evening. We're going to talk about lender pricing changes, lender criteria changes. We're going to have a look actually at some of the kind of thoughts that are sitting around some of the tax changes that are going to come in, and potentially as a landlord what you can do to protect yourselves. And then we're going to have a quick look as well to see how the old property market is faring at the moment. Okay, so let's have a look at swap rates. Like I say, they're from Monday evening. I think maybe on Wednesday morning things may kind of have moved, but where are we at the moment? So 2-year swaps 3.49, 1 month ago 3.7, and 5 years 3.56, 1 month ago 3.76. So both are down by sort of circa 0.2%, which is kind of where we were last week. So if you watch this video frequently, you would know that from last week's video, swaps have seen a notable step down over the kind of week period by around 0.2%. They haven't really moved from there, but the good news is that because lenders' cost of funds has come down by circa 0.2%, that's kind of really left the door open for lenders to bring down pricing. Now, it could be that Rachel Reeves' statement today, I don't think from what she was saying anyone's going to be particularly shocked. So I think what she's trying to do is kind of go in with a brace yourselves, guys. There's going to be some tax implications here. We're going to have to put taxes up. We don't know what that's going to be, how it's going to be kind of balanced, but they are on their way. But this is kind of the context around why we're having to make these tough decisions and fundamentally break their manifesto as well, which no government wants to do. That's not a very good look by any stretch of imagination. So essentially justifying and getting everybody ready. So it'll be interesting to see how the capital markets respond to that. I think realistically, this statement won't have come as a huge surprise to most people, so I don't imagine the capital markets are going to have a massive kind of conniption in response to it. But you know, these things sometimes do have a more profound impact than maybe we would be forgiven for imagining. So let's just wait and see what happens. Okay, so in terms of lender pricing changes over the last week, we have seen, as predicted, a little flurry of lenders bringing rates down. Really, the sort of general theme seems to be 0.15%. There's some who've gone a little bit more aggressively and some who've gone slightly less. Why do lenders vary? Because there's lots of reasons. I mean, it could be that actually they were kind of taking more of a hit on their margins than they ordinarily would to try and attract new business. So let's say they were taking a hit of 0.5% or 0.05% on their profit margin. Swap rates come down by 2%. Therefore, like, well, actually, 0.2%. I wish I had come down by 2%. So actually, if we drop rates down by 0.15, we've kind of clawed back the 0.05 we were losing previously, and we've also been able to pass on some of our reduction in cost of funds to our borrowers as well, which can only be a good thing. It could be that actually they're being greedy. I suspect that isn't the case, but I'm sure the more cynical among you will be also wondering this. But there's lots of kind of things that go into lenders pricing. So, you know, it could be that actually one of the lenders that's brought their rates down is really busy at the moment and doesn't want a whole load of business. They want to try and share the reduction in cost of funds with borrowers, but likewise they don't want to be absolutely swamped with business because they've already got too much on their books. So they're going to make a kind of token gesture. So just to kind of give you some context around why, when we say swap rates have come down by 0.2%, why hasn't everyone simply reduced their rates by 0.2? There's a bit more to it than just that. So who has made reductions in the last week? HSBC down by 0.15%, Accord down by 0.2%, and YBS, weirdly, is part of the same group as Accord, also down by 0.2%. Now, YBS are essentially a commercial lender that do buy-to-let mortgages. They are absolutely wonderful. They have some really, really good rates at the moment for limited company buy-to-let. So if you've got a straightforward buy-to-let transaction on a vanilla property owned personally and you own less than 10 buy-to-let properties, you can go to Accord Mortgages, which is part of the same group. But actually, if you've got anything which doesn't really sit in those kind of fairly rigid parameters, then YBS could be for you. I've just got terms from them for a client who's looking to refinance a block of 20 flats with commercial on the ground floor. They are heads and shoulders in terms of pricing beyond their competitors. Rates at kind of like 5.5%, so really, really good. LendInvest rates down by 0.05, Paragon down by 0.15, and Aldermore also down by 0.15% on some of their products. Now, for the eagle-eyed amongst you, most of you will notice that most of the lenders we're citing here tend to be the more specialist lenders, the lenders you don't find on your high street, generally institutions you're not saving money with. So these guys are essentially leaning more heavily on the capital markets, where we have seen the reduction in swap rates in the last week. So that kind of is how it all hangs together. Is there room for more lenders to bring their rates down over the next week? I certainly think there is, but let's just see what happens. Like I say, I can't kind of keep going back to this enough. What happens with swap rates overnight because of the statement by Rachel Reeves. It could be that swap rates react very badly to this. They go up, in which case we might see a wave of rates going up next week, but they equally could come down. Let's just see what the people in the city think of her speech. Okay, now moving on to lending criteria changes, and we've seen two very different lenders make two very similar types of change to their lending criteria. I think it's a total coincidence, but what I think it really does do is serve to illustrate the point that lenders are working really, really hard to try and look at their lending criteria and see what they can change to better serve the landlord community. So well done to those guys. So what we've seen is, first of all, a mortgage lender called Molo Finance. Now, Molo are compared to kind of like lenders that have been around for donkey's years, a new kid on the block. They've actually been around for quite a few years now as well. Some of you will remember we went through a phase a few years ago where we seemed to be getting a new lender to market every single week. That's really slowed down, but Molo would certainly be one of the more recent, newest additions, but even then they've still been around for a long time. And what these guys have done is they've taken a look at their kind of maximum loan per security and increased it. And the amount that you can borrow will depend on the loan to value. So to illustrate that point, what they're saying is if you're borrowing below 70% loan to value, their maximum loan per single asset is £3 million. If you're borrowing between 70% and 75%, your maximum loan is £2 million. And if you're borrowing over 75, so they end up to 80% loan to value, maximum loan there is £750,000. So that's really good, really kind of ramping up the numbers in terms of what they can do on a single asset. And interestingly, the Mortgage Works, who are nothing to do with Molo at all, have done something really similar. So what they're saying now is that their maximum loan per property has increased to £2 million for buy-to-let and limited company applications and £1 million for let-to-buy applications. A let-to-buy application is where you want to put a buy-to-let mortgage onto the property which you currently occupy as your home to allow you to rent it out and then buy something else or move in with family or whatever it is you're planning on doing. Hopefully, you know, if it was me emigrating to the Bahamas, that kind of thing. But so again, what they've done is they've really said, actually, we're willing to kind of expose ourselves and to a larger level of debt per single asset. So that's really interesting. Now, what they've also done is they've increased the maximum amount of borrowing that anyone can have with the Nationwide Group. So for those of you who aren't aware, the Mortgage Works is owned by the Nationwide Group. And what lenders all will do is say, okay, we will lend a maximum of X amount per property, as we've just talked about. What they'll also do is say within the that lender, or even as a group, there's a maximum level of exposure they're willing to have for you. So the Nationwide Group, which includes the Mortgage Works, they've increased the maximum level of borrowing you can have across all those lenders to £7.5 million. As an example, another lender where this kind of really comes up often is the Lloyds Banking Group. So within that you've got Halifax, Bank of Scotland, Cheltenham and Gloucester. We've got BM Solutions and another couple of lenders that used to be around that no longer lend as well. So with the group, they will have a maximum group exposure. So within the Lloyds Banking Group, you can only have X amount of borrowing or so many number of mortgages. So really, really great to see that the Mortgage Works have gone back, revisited this and kind of opened their doors just that little bit wider. Now, with the much anticipated, put it politely, autumn statement on the horizon, what we're very much seeing is that people are just kind of holding off making any big financial decisions, and understandably so. So it was interesting when the HomeTrack report sort of arrived in my inbox, because this is a really, really good report actually. It's totally unbiased, and it gives lots of really useful data about the housing market. And so I was very interested to see what's going on in the housing market according to these guys. So I wanted to share with you from the latest report their kind of key takeaways. The first thing they're saying is that budget uncertainty is prompting a wait-and-see approach from buyers, leading to a cool down in market activity. Buyer demand is down 8% compared to last year, and sales agreed have fallen 3%, which is the first annual decline in 2 years. So essentially less people are thinking about buying right now. Again, I strongly suspect that the budget will be announced and most of those people will then go forward with their plans. So I think often people aren't necessarily changed by the outcome in these budgets, not always, but often, but they just want to understand what they're dealing with first of all. So actually it could be that for a lot of people it doesn't actually matter what Rachel Reeves said, as long as it's not utterly disastrous for them. They will continue with their plans, but they just want to understand what they're getting themselves into before they go ahead and push the button on any kind of big financial commitments like taking on a new mortgage because they're buying a new house. So it'll be interesting to see kind of how that does really impact things. But that's the kind of first bit of data which I thought was worth sharing. The second thing the report goes on to say is that UK house price inflation remains steady at plus 1.3%. So year on year, houses across the UK as an average are 1.3% more expensive than they were 1 year ago. However, what they go on to say, and this is the kind of important thing, is that this figure masks a growing regional divide, with prices flat in southern England but rising by over 2% across Scotland, Wales and northern England. So actually, when I read this report, I was like, oh lovely, because my house, my home, my buy-to-lets, we're all in the south of England. So I was thinking, thank goodness, at least they've gone up by 1.3%. But the reality is they probably haven't moved in the last 12 months. But actually, if you have property in the north of the country, Scotland, Wales, you will have actually seen those prices increase. Now, the third point, which is kind of a key takeaway, which I find quite interesting, is that there is an increase of homes for sale. So 7% more homes per sale than there were 1 year ago, and it's giving serious buyers greater choice. Softer demand has pushed the average time to sell up to 37 days, which is 10% longer than last year, making realistic pricing critical for sellers. So what I'm kind of hearing here, I think, just kind of trying to bring this all together in a nice little summary for you, is that actually for those of you who are thinking about selling property, the reality is if you want to get it gone, for the time being, you're going to have to price it really competitively, or it needs to be an absolutely stonking property, which is like, you know, within spitting distance of the best primary school in the area, that kind of stuff. So the reality is you are going to have to be flexible on your price. The other thing is, and I suppose conversely to that, if you are thinking about buying a property at the moment, if you are thinking about investing, actually this could be a very good time for you, because the general consensus, and kind of echoing back to what I was saying a moment ago, is that reality is that a lot of people are just waiting to see what happens in the budget. And unless something really kind of crazy happens, and I'm not ruling that out by the way, but let's assume that it doesn't, people will then pick their plans back up and carry on. They're just waiting to see what happens just in case. So actually, I suspect that once we get the autumn statement out of the way, we'll probably then kind of have Christmas and then come into the new year, and you're probably going to find, I suspect, the housing market is going to start to gain a bit more momentum, which could mean that actually you face paying a higher price for property than if you just bought it now. Now, conversely, and I think another thing we need to think about within that mix is interest rates. Lots of talk about a base rate reduction in December. It's not guaranteed, but actually with the economy performing as it is, with the inflation being not as quite as much of a disaster as people thought it was going to be, this is now really kind of paving the way for a base rate reduction in December. So what you could find is that actually if you time it absolutely perfectly, you'll benefit from interest rates softening ever so slightly, but also with house prices where they are at the moment before things start to gain momentum in the new year. So we've got the Renters' Rights Bill in, and so people are now kind of starting to really think about what they can do to protect themselves from that. But actually, we also have the autumn statement coming up, which I've obviously talked about a lot today. So I thought it'd be just useful to kind of run through the things which I see as being the key areas, which as landlords specifically, you need to be keeping a watchful eye for, and also maybe offer up some kind of thoughts as to anything you can do to protect your position, essentially. So just to be very, very clear, all the things that I think are under consideration, nothing's been agreed or announced is probably the better word, probably has been agreed by now, but nothing's actually been announced. So the reality is that what I'm not saying is these things are definitely going to change, but they are certainly in the mix of things that could change, so worth being aware of. So the first thing is national insurance on rental income. So a report suggests the Treasury is considering extending the scope of national insurance to include rental income, which is currently exempt from national insurance. Estimates are suggesting that this could raise potentially another £2 billion worth of revenue for the government. Now, if this is introduced, obviously landlords could face extra tax charges on rental profits or perhaps gross rental income rather than just tax. So I think realistically, the kind of thing that I would definitely say to people here is that actually properties owned in a limited company would be slightly different, as I understand it, although obviously nothing's been kind of properly announced. But this is probably going to mainly impact those people who own properties personally. I'm one of them, don't worry, I'm not exactly full of glee about this particular prospect. Now the next one is further changes to capital gains tax reliefs. So whilst the rates for capital gains tax on residential property, which is either 18 or 24%, remained unchanged in the last budget, there is very much speculation that either the allowance or exemption could be cut further, or that capital gains tax could be applied differently. So it could be applied, for example, to main residences above a certain threshold. So at the moment, if I sell my home, because it's my home, I don't pay any capital gains tax on any money that I've made. There is a possibility that actually they could start taxing capital gains over a certain level, even if you're selling your main residence. The kind of downside of this as landlords particularly are that actually this could mean that if the capital gains tax thresholds were to be reduced, or the amount of tax that's paid on the capital gains is increased, when you sell your buy-to-let properties, you could face a higher tax burden at this point. Now, the government is also reportedly exploring broader property taxation reform, for example, replacing stamp duty, land tax and council tax with some form of land or property tax, applying taxes to high value homes and so on. The implication here is that long-term ownership of rental property, especially high value properties, may attract new forms of tax, which could obviously be quite expensive. Now, in terms of these things, it's very hard to make preparations because we don't know what's going to happen, and sometimes the government are really kind of wily and they bring in changes almost overnight. So literally their budget would be announced and the next day these rules are in place, which leaves you no time to kind of make any changes. They're not stupid, are they? So here's some things that you could consider doing right now, and I'm certainly not saying you should be doing these things. Very much always speak to the right people in terms of tax advice, accountants, solicitors, all that sort of stuff, but just some food for thought for you. So first of all, actually just consider your acquisition strategy. So with stamp duty, land tax surcharges higher and thresholds dropping, the cost of buying additional property could be rising. So maybe just thinking about, rather than selling something to buy something else as an example, which we're hearing people consider doing, how about looking at the asset you've already got and thinking what you can do to make that asset more efficient for you? Could you convert it into an HMO, a holiday let, split it into flats? Could you make green changes to it? Those kinds of things. Another thing is that if you run holiday lets, then it's really worth considering your business model there and adjusting things accordingly, because the way holiday lets are going to be taxed will be changing to bring it more in line with rental properties. So that's something you need to consider as well. For those of you who are considering incorporations, it could be time to start fast forwarding those considerations. You've obviously kind of you are paying the increased tax from Section 24. With the national insurance, if that were to go up, that's going to be just another layer of tax that you're paying on your rental income as well. So actually, potentially by putting the properties into a limited company, by incorporating, yes, I know it's expensive to begin with. Yes, I know limited companies have higher rates of tax, but actually there is a reason why lots of people are still going down this route, because actually financially it can still make sense for people. So definitely worth another think about. So there you go, lots of changes on the horizon for landlords. I think we're all feeling, I feel like we always feel battered, but this is like an exceptional moment in time. Hopefully the budget will be kinder to us than we're thinking it will be, but let's just wait and see. But in the meantime, like I say, it's really worth just kind of reviewing things, looking at the properties you've got, look at the ownership structures, looking at how you're going to buy things in the future if you're thinking about investing in the near term, and just really kind of making adjustments where you possibly can. Great people to have on your side and in your team: tax advisors, accountants, good solicitors, absolutely worth their weight in gold with this kind of stuff. And of course, a good mortgage broker. And there you go, that is us for this week, and that is me signing off for the week, because I'm about to hot-foot it off to Lisbon and eat my body weight in pastel de nata. I probably won't have to fit my face on the screen after the massive custard fest that I'm going to have while I'm there. So look, I might not be around, but the team is still very much working. So if you have any questions, please do give us a call, 0345 345 6788. Have a look at the website, send us an online inquiry, you know the drill. Look after yourselves, have a really fantastic week, and I'm really hoping that if nothing good comes of all this stuff at the moment and we're all feeling a bit kind of low, I at least might be coming to you with some news of some lower swap rates next week, and therefore some better mortgage pricing. I'll see you next time.